If you're looking for that ultimate shortcut in technical trading, it probably doesn't get simpler or honestly more frustrating than horizontal support and resistance levels.
Right.
I mean, every trader knows how to draw these lines, right? But knowing when a line has actually broken, well, that's the key. That's where the money
Yeah,
is.
it really is.
Most new traders, they fail because they mistake, let's say, hesitation for commitment from the market.
Mm-hmm.
So our mission today, let's cut through all that noise. We're doing a deep dive into the foundational property of these horizontal levels. Specifically, how the mechanics of a breakout, a real one, immediately tells you the current market trend direction and helps you spot relevant entry points.
So you absolutely have to get this right. I mean, to even start this analysis properly, you need to confidently identify your two nearest horizontal levels.
Okay, the ceiling and the floor.
Right. The resistance ceiling above the current price and the support floor below it. Why? Because the first, most critical property is, at its core, simple. The direction of the confirmed breakout points directly to the immediate path of least resistance for the price. It's the answer, really, to that fundamental question: which way is the market trying to move right now?
Okay, so let's unpack those signals then, those definitive signals. Maybe start with the positive, the upward tendency, the bullish confirmation.
Okay, bullish. A strong bullish signal is established if the market price breaks through that resistance level, moving from the bottom up, obviously, and is set to close. And I really mean the solid body of the candle closing.
Not just the wick poking through.
Exactly, not the shadow. The body has to close above that nearest resistance level.
Right. And the implication of that confirmed close is, well, it's huge, isn't it?
It is.
It signifies that the buyers, they've successfully soaked up all the selling pressure that was sitting at that old ceiling.
They broke through.
So the market can theoretically keep moving upwards. And that makes long positions immediately relevant. And that old resistance level, it flips, right? It becomes your new floor, your new short-term support.
Precisely. It flips function. And naturally, the bearish confirmation is just the inverse of that. The downward trend, the downtrend, gets confirmed if the price starts moving down and is set to close below the support level.
Okay. Same logic, just downwards.
Same logic. This implies that, well, in the short term anyway, sellers are in control. The market might fall further, and so searching for entry points to sell or short becomes highly relevant. And again, that old support level flips. It now acts as the new resistance, the new ceiling.
Now, something our research really emphasized, and I think this is crucial,
Yeah.
this isn't a static exercise. You don't just draw lines and walk away.
Oh, absolutely not. The market landscape is always, always changing.
So as the price moves, you have to constantly recalibrate, right? Update where those nearest support and resistance levels actually are now.
Yes. They're fluid. They're not set in stone forever. That concept of constant updating, it's really non-negotiable for this to work. And we should probably also add some context on the nature of the movement itself.
What do you mean?
Well, a confirmed breakout, whether it's bullish or bearish, it doesn't mean the price is going to shoot up or just plummet down in a straight line forever.
Right. That's where traders get impatient, isn't it? They see the break and expect, rocket ships.
Exactly. Even if the overall trend is definitely bullish after a confirmed breakout, price growth always includes periods of recession or corrections, little pullbacks.
Or prices temporarily dip even though the bigger trend is up.
Precisely. They decline against that main trend. The balance between buyers and sellers is constantly shifting. It's a dynamic push and pull. So developed markets, they move non-linearly, always. Our sources really hammer this home. You must expect these corrections, these temporary pullbacks. They're normal.
Okay, so let's say we've just confirmed a bullish breakout. Price closed above resistance. Then we see the price kind of drift back down a bit towards that line it just broke. That's not necessarily a failed breakout then.
Not necessarily, no. Often it's just a correction within the new upward tendency. It's the market sort of pausing, catching its breath, consolidating its new position above the old ceiling.
As long as it stays above that line.
Exactly. If that retreat stays above the newly confirmed support level, the old resistance, then the overall direction set by that initial breakout is still intact. You only really start to worry if the price closes back inside the previous trading range below that flipped level.
Which brings us, I think, to maybe the most critical distinction in this whole discussion. Distinguishing between a genuine, confirmed breakout and that really dangerous false signal, what you called a test of a level earlier.
Yes. This is absolutely where the money is lost. Or made, if you get it right.
The impulsive trade taken on, like ambiguous data.
It is. This is the difference, really, between informed technical analysis and just gambling.
So defining a test is absolutely paramount then. You said this happens when the market comes up to a level or down to one, and breaks it only with the candle shadow, the wick.
That's right. Or perhaps it touches it with shadows for a few candles in a row. The price movement briefly pokes through the line, maybe causes some excitement.
Yeah, trigger some stops maybe?
Could do. But the solid, undeniable part of the candle, the body, it retweets. It closes safely back behind the level within the old range.
Okay, so that price movement, even if the wick went way past the line.
Doesn't matter how far. It absolutely cannot be considered a completed breakout. The core rule here, the one you absolutely must rely on, is the power of the closing price. Traders have to rely on that closing price, the candle body's final position, to truly confirm a breakout, above resistance or below support.
Okay, well, let me push back on that slightly because this is something I think trips people up. If the candle shadow, the wick, pokes, say, 20 pips above resistance, isn't that showing immense buying pressure?
It shows attempted pressure.
Right, but doesn't the shadow represent real money moving? Real trades happening up there? Why would we just throw out that data because the body retreated? It feels a bit counterintuitive, like ignoring strong momentum during the candle's life.
That's a fantastic point, and it's where the nuance lies. Yes, the shadow absolutely represents trading activity. Real orders were filled up there. But what the shadow ultimately represents by the time the candle closes is a failed attempt. The closing price, where the body ends up, that represents the final settled consensus of all market participants for that entire time frame, whether it's an hour, 4 hours a day. If the sellers manage to push that price all the way back below the resistance line by the time the candle closed, it means the buyers, despite their initial push, failed to hold the ground they momentarily gained.
Okay. So the shadow is like the reconnaissance team, the probe. But the body is the army actually holding the territory.
That is the perfect analogy, exactly. Imagine the wick is a hesitant probe, maybe a fishing line dropped into enemy territory. But the solid boat, the main force, that's the candle body, it stayed safely anchored behind the resistance line. That level was successfully defended by sellers in the end. You don't launch a full invasion based on a fishing line snagging something briefly.
Got it. No, you don't. Okay, so let's get even more specific then. Picture this. A candle opens above a resistance level. Looks great, early bullish momentum.
Happens all the time.
But then, through the candle's duration, sellers fight back, they drag it down, and it ends up closing below that resistance level.
Right.
Or maybe it closes sort of within the price zone if you've drawn resistance as a small zone, not a thin line.
Yes, either way.
In both those cases, there is no fact of a breakout, right?
Correct. No fact. Zero confirmation. You simply cannot draw conclusions about a trend shift, bullish or bearish, until you have a clear, solid body closing established outside that zone or level.
You need proof of commitment from the market, not just curiosity or a brief skirmish.
Precisely. Commitment, not just curiosity. Well said.
Okay, so if we agree on the mechanics, the necessity of the close, let's talk about the human element, the psychology. What happens when the signal is just messy?
The ambiguity.
Yeah. What about when the market closes just a tiny, tiny amount, a few pips, maybe above resistance or below support?
Yeah.
Is that a complete tradable breakout? It technically closed outside, but just barely.
This is where it gets really fascinating, because this is where technical analysis bumps right up against collective belief. What's really interesting here is that support and resistance levels, like many charting patterns, they work primarily because traders globally believe they have to work. It's a kind of self-fulfilling prophecy, a consensus mechanism.
Okay.
So when that signal is ambiguous, when it's messy, like you said, that consensus breaks down immediately. People aren't sure.
Right. Because if a close is visually ambiguous, you risk being maybe the only person, or one of very few, who thinks the move is actually confirmed.
That is the crucial rule we derive from this, the rule of visual clarity. The source material we looked at is very, very blunt about this. It basically says, if the breakout is so hard to visually determine that you find yourself having to zoom way, way in, like 500%, just to see if it closed maybe a fraction of a pip past the line.
Yeah.
The professional recommendation is simple. Do not consider it a completed breakout. Just don't. I remember early on in my own trading, I'd be squinting, zooming in, trying to will the breakout to have happened.
Trying to justify the trade you already wanted to make.
Exactly. I was basically just lying to myself to justify getting in. It never ended well.
So the rule is, if you're straining to see it, if you have to zoom in excessively to confirm the signal, treat it as if it didn't happen.
Treat it as non-existent. Yes. Why? Think about it. If you have to zoom in and squint, then literally millions of other traders around the world looking at the same chart are asking the exact same question. Has the breakout actually been confirmed here or not?
There's no clear agreement.
There is zero consensus on the chart at that moment. And that lack of consensus immediately, drastically lowers the probability, the success expectancy of that signal, because not enough capital, not enough conviction will flow in to strongly support the new direction.
That makes perfect sense. If there isn't clear agreement visually, the big money, the institutional flow, isn't likely to jump in forcefully and the movement just fizzles out or reverses.
So it stalls or snaps back. So instead of jumping in on that ambiguous, messy close, the prescribed action is patience. Simple patience. You wait for clear confirmation. What does that mean? It means the next candle opens and then obviously clearly closes higher for bullish or lower for bearish, unequivocally proving the level has been breached. Or you wait for a complete denial of the signal where the price just snaps right back into the previous range decisively. Either way, you wait for clarity.
This patience thing, it's key, isn't it? And it links directly back to some of the sort of experiential advice we found in our sources. It really highlighted that traders who spend their time trying to guess which level is about to be broken, the predictors, the ones trying to anticipate based on a faint signal or a feeling.
Yeah, the crystal ball gazers.
They lose money far more often than those who focus solely on the confirmed fact of a breakout or a rebound after it has clearly happened.
It's about reaction, not prediction. Your focus should always, always be on following what the market did, confirming its action, not predicting what you think it will do next. The moment you start trying to predict, you're injecting emotion, hope, fear, bias into a process that should be, as much as possible, mechanical and reactive based on clear signals.
So the simple, clear approach to just this first property of S&R levels, it's powerful precisely because it strips away that guessing game.
It really does. The successful trader's main mission here is straightforward. Know these key properties, like the importance of the close and visual clarity, and then apply them clearly, consistently in practice. The common danger we see, again and again, is traders overcomplicating things. They make plotting the levels themselves too complex, maybe drawing far too many lines, or trying to account for every single tiny wick wiggle.
Analysis paralysis.
Exactly, which leads to doubt, confusion, and then, inevitably, attempts to guess or force trades instead of just waiting for the market to show its hand clearly. That complexity defeats the entire purpose of using technical analysis in the first place. Keep it simple. Identify the two nearest significant levels, and then wait patiently for the solid body of a candle to clearly close outside the previous zone. That's it.
That really is actionable, immediate insight.
Yeah.
We basically established that the difference between success and failure in using support and resistance analysis hinges almost entirely on clear visual confirmation and an almost religious reliance on the candle's closing price.
Couldn't have said it better myself. The close is king.
So let's leave you, the listener, with this final provocative thought then. It builds on that idea you mentioned, that these analysis tools, these lines on a chart, they work largely because of collective belief.
The self-fulfilling aspect.
Right. So if market movements are ultimately dependent on the visual clarity of something like a closing price, meaning the move gains momentum because enough traders agree visually that the level broke, then how much of trading success is actually based on the pure mathematics or geometry of technical charting? And how much is based purely on understanding and aligning yourself with market psychology? With that collective consensus, where does charting end and psychology begin?
That's a deep one.
Something for you to maybe explore on your own. Okay, that's it for this deep dive. We really hope this gives you a much clearer view of the road ahead in your trading, especially around these fundamental levels. We'll see you next time.